Alrighty, so I hope you all enjoyed your lunch. We're going to move right into our next speaker, James Swanson. He is the Chief Investment Strategist of MFS Investments. In that role, he meets frequently with MFS portfolio managers and analysts to cull their views about the economy, financial markets, and corporate health. In 1985, Swanson joined MFS as a fixed income credit analyst. He then served as associate portfolio manager, and research analyst before being named to the position of fixed income strategist in 2001 and chief investment strategist in 2004. He also serves on the MFS Fixed Income Strategy Group. He is a graduate of Collegiate University, where he was inducted into Phi Beta Kappa. He earned an MBA, along with classmates George W. Bush and Jim Koch, the founder of Samuel Adams Beer, from Harvard University Grad School of Business Administration. Swanson holds a Chartered Financial Analyst designation and is on the board of directors of Fixed Income Society of Boston. He often appears on TV as well, such as CWBC, and will be on Fox TV next week. So please welcome James Swanson.
Thank you. Good afternoon. Thank you all for coming out for this. I really appreciate being here. Why am I here? My company's a big sponsor of the co-op program. Huge success at our firm at MFS. Who is MFS? We are the founding mutual fund company in America. It was started here in Boston, and my firm was the original one. It was originally called Massachusetts Investors Trust, still in operation today. I just had a call today from one of your alums at Northeastern. He's a big success on Wall Street and invited me to dinner this week. So we've got some very good examples of people who went through our co-op program and did well in this particular field. My job is strategist, and the way that works is I'm not an economist, but when the world asks MFS, where do you think the economy's going, or what do you think of these markets given that outlook, where should we invest, where should we not invest? And so that's what I want to talk about today. But what's interesting about my job is I also manage a mutual fund. It's a pretty big one, and it's got 5 asset classes. So I'm one of the few strategists out there that just don't give their opinions. I get paid on whether I get it right or not with real money. So that would be my other job. So I have 2 jobs at MFS. I've been to Northeastern a few times giving guest lectures. Professor Platt is in the back of the room, and I've worked with him originally 20 years ago on his book and have been a guest lecturer at his class. Very enjoyable experience. I'm a big fan of architecture, so if you're a senior, you're going to graduate in 2.5 weeks, I would walk around and appreciate what you've got here. You've got some cutting-edge architecture, not only on your campus, but within 2 blocks of here. So make sure you don't take all that for granted. What I'd like to go into now, and my only rule is that there's no such thing as a dumb question, so you can ask me anything you want. And I would like to talk for 15 or 20 minutes how we see the world economy unfolding. The biggest risk, as we see it, to people's jobs, their livelihood, their savings, their portfolios, historically is recession. So my first chapter is going to be, are we faced with a recession in 2013? Jim, if not, then what's going to keep this business cycle going? This business cycle, by the way, started 4 years ago, this July, with the end of the last recession. So just about when most of you were coming here, we were ending a recession, and you've been here during an expansion. The question is, where do we go from here? The second piece to it will be, if there is life to this expansion, what will drive growth going forward here in China and in Europe? What are the tail risks? And then how do you invest in this climate, in this environment? So that's what I would like to do, and we'll open up for questions after I give you some of my views. So number one, what I would like to talk about is there a recession? Can you hear me? Is there a recession coming in 2013? I have my radar tuned up pretty highly for the prospect of recession. That's part of my job. And number one, let's look back at business cycles in the past. Here in the U.S., the average business cycle lasts about 5 years. This business cycle is about 4 years old, so we might be due for a recession if this is a typical business cycle. Number one, I don't think it is a typical cycle for one salient reason that not too many people are talking about. The growth in the U.S. isn't stupendous. It's not a boom. It's about 2%. This whole channel we've been growing through for 4 years, 2% real. But it's not been driven by an expansion of credit at the corporate level or at the consumer level. Believe it or not, consumers are still deleveraging and corporations are still deleveraging after the Lehman crisis of 4 years ago. So what does that mean, Jim? Well, it means that if you go back and look at history, of the 11 recessions we've had since World War II, 8 to 9 of them were triggered by the Fed raising rates against a rising credit cycle. Now, they weren't trying to stop the economy. They were, in most cases, trying to throttle back either bubble-type conditions or, most often, inflation. Those circumstances don't exist, number one, because we have Mr. Bernanke, who is trying to be transparent. He's in control of the largest central bank in the world, has an infinite balance sheet, and he's telling us he's not going to raise rates. And he's not the least bit concerned about inflation this year. So that's, I think, risk number one is really not on our radar for any kind of Fed intervention here this year. Number two, the credit cycle suggests, and the excess capacity in this economy suggests, we're not faced with inflationary pressures yet. I do think they will come, but we haven't used up our physical plant, and we haven't used up our labor pool. As you know, you probably saw those non-farm payroll numbers that came out Friday. So the economy is creaking along. It's not a boom, but it's actually more sustainable, in my opinion. And we have had cycles last 8 or 9 years. It's more sustainable than some of these other cycles that ended in 3, 4, 5 years because it's not being driven by credit. And this 2% real growth, the sort of channel we're in, as unexciting as it might be, is more sustainable because it's not driven by credit, and more interesting to me as an investor is corporations in the U.S. have been delivering fantastic results. If you were grading the U.S. corporate landscape here in a 2% growth environment, the press says this is terrible, the labor markets, everyone's discontent with this situation, but the markets keep going up, and the markets keep going up because U.S. corporations have almost never been in better shape. And how would I measure that? I would measure that by looking at the last 2 peaks of the stock market. And you can go back to the tech peak, and that was roughly October of 2000. And the S&P was exactly where it is today, something like 1530, 1540. At that time, if you bought the index, you would have bought half the earnings you've got today. You would have bought leveraged companies, on average, over 35% debt to equity. You would have gotten less of a dividend stream. You would have gotten less cash flow per share. Same thing is true of the market peak back in 2007. I'm sorry, the technology boom was 2000, and then the next boom was October of 2007 before the Lehman crash. And again, the market hit right around 1560, roughly where we are today. And again, you would have bought at that time less earnings, less cash flow, and more leveraged companies. Today, we're witnessing less debt per equity on these companies than we've seen in 35 years, record cash flow as a percent of GDP, pretty close to record profit margins, net profit margins. Corporations are getting straight A's here, and that explains why the market is going up. One of my best indicators of a recession is this one. I think it's a pretty cool one. This is profit share of the U.S. GDP. So we're talking about the U.S. business cycle, and those are sort of the purple or magenta lines there, and the blue line is profits as a percent of GDP. This number tends to go down and tends to flag downward 3 to 4 quarters, roughly a year in advance of a recession, and it tends to be moving down about 6 months before a market peak occurs, and those usually occur 6 months before recessions. Right now, you've got a couple of false positive readings, but not too many. This is really an incredible indicator. And as you can see at this point, this indicator isn't flashing red. So number one, no Fed. Number two, corporate profit margins, which I think are a lead indicator of how well this society or this economy is doing, not showing signs of fatigue here. Another way you get recessions is the creation of bubbles. Too much capital going to some part of the economy. You could see that certainly in 2000 with the tech boom. Way too much capital went to the tech sector. Took years, a decade, to get rid of the excess capacity, the excess capital that went there, the overpricing. Another way you get it is the housing bubble. And you can see what happened here. The U.S. economy went berserk, building single-family homes, again, fueled by credit. And this side, it was the consumer balance sheet that went berserk, borrowing like crazy leading up to 2007. And this long-term trend line of household debt to personal income was broken dramatically leading up to 2006, 2007. And we are still experiencing the after effects of that. So that was the cause of the last recession. But you sum it all together, the three major causes of recession, interest rates and credit, corporate profit margins deteriorating, and or the deflation of a bubble, don't see it. Don't see any signs of a bubble out there. You could maybe suggest the U.S. government, we'll talk about bonds in a minute, may be borrowing too much, but I think that's debatable. But right now, there are no excesses that we can find in the private sector. Again, there isn't a lot of credit formation. There isn't a lot of excess capital going into the private sector in any particular form. The stock market itself, its forward price-earnings ratio is average by historic standards. So point number one, chapter number one is, as an investor, it's my view, and people have been saying the sky is falling for 4 years. It hasn't happened yet. I don't see the ingredients of a collapse here, and I don't see the ingredients of a recession, even a mild one in 2013. And I know the markets got spooked this week with slower job numbers, but the overall impression I'm getting of this economy is it's in okay, decent shape. Let me take you as to what will drive it now. Number one, there's been pent-up demand out there. Corporations, for 2 cycles now, have been underspending their traditional amount on what we call CapEx, big-ticket items. The biggest category out there is IT land now. The biggest category of long-term expenditures by companies is computers and software. And right now, the installed software in S&P 500 companies is the oldest ever. The entire physical stock of the S&P 500 is the oldest we've witnessed in 50 years. So it's pretty clear companies have not been spending. We can measure this, their capital expenditure budgets against depreciation, against GDP, against sales. No matter how you do it, they've been underspending. I would make the argument that with an aging capital stock, the U.S. corporate sector has a lot of pent-up demand. They've got cash on their balance sheets, highest since 1954. Again, a 50-year record. They've got the money to spend on big-ticket items. That has to be, in my opinion, number one propellant going forward to push this economy forward. So that would be number one. Number two, jobs follow CapEx. The CapEx line has moved up a little bit, but jobs follow with an 8 to 12-month lag. I would expect that you will see better jobs numbers coming just from that pent-up demand. Another, that would be, I would call one of the 2 C's, corporations. The other C would be the consumer, 70% of the U.S. economy. And what's their story? They also have been underspending on big-ticket items. So what are their big-ticket items? Appliances, cars. Let's take a look at the car situation here in the U.S. Big part of the U.S. economy still. There's no question about it. Big ripple effects there. Does anyone know the average age of a car on the road in the U.S. today? Anyone want to take a stab at this one? 7? We got a 7? We need a higher bid. No, that's a little on the high side, but great try, great cool. It's 11. Who said 11? All right, I don't have any door prizes, but you could have an extra lunch. But yeah, it's 11 years old. My car is 12 years old. I have to admit that. I don't know how many more winters in Massachusetts I want to drive this thing on the streets with the snow out there. But I have begun the process of thinking about replacing it. This must be going on in every household out there because this is the oldest we've seen. And people say the cars are better now. Maybe, but at some point they're physical depreciating assets and they go downhill. The same is true with appliances, washing machines, air conditioners, all that sort of thing. Big ticket items, as far as they can measure this, the longest lead time or the oldest age the U.S. consumer has had. So pent-up demand also building on the consumer side. Another reason why this cycle will be sustained, not just pent-up demand, but unit labor costs. Now, what are you talking about? Well, if you look at the labor costs in the U.S., you'd say per hour they're very high compared to the rest of the world, for sure. Compare it to China, compare it to Korea, compare it to Eastern Europe, yes. But unit labor costs, what we're paying per hour worked, given what we're getting on the other side, services and goods, We're now ranked second in the OECD world, the developed world. In other words, our productivity is the second best in the world. In other words, the problems in Europe, for example, in my opinion, are not too much debt. They are driven by constraints on labor. In this country, labor resets itself every recession. There are very few constraints on how labor is shed or added. There are minimum wage laws here, but nothing compared to Europe. Europe keeps losing its share of world trade. China's unit labor costs keep rising and rising and are beginning to take away that advantage of transportation, which is about 1% a day of a cost structure to bring that stuff in containers back to the U.S. And manufacturing is beginning to come back here. U.S. job growth since the end of the last recession, this whole cycle, has been driven by the manufacturing export sector. And I think that continues because, bizarrely enough, the U.S. actually has very competitive unit labor costs, and labor is a big component of exports. So that would be another reason for this thing to go on. Lastly, I think not just manufacturing, but the second half of this cycle, and I could imagine this cycle going on for 2 or 3 more years, will be driven by housing. Housing is, here's stat number 1. Right now, we're spending 2.5% of our GDP. The U.S. economy is being spent building single-family homes. This equates to the Depression. At the peak in 2006, 2007, we were spending about 6.5% of our economy on building houses we didn't need. Bubble, too much capital going to one sector. The long-term average is 4.5% of GDP. If we just go back this year from 2.5% halfway to the 50-year average, we would add 1.5% to 2% to GDP. Why? There's a high multiplier effect in the housing sector, very labor intensive. Think electricians, think roofers, think the ripple effects that go, for example, into the textile industry with drapes, carpeting once a house is built. The chemical industry benefits on the paint side of it. Glass manufacturing, there's a massive ripple effect when you build new houses. Right now we're at depressed levels. Since the peak of the housing market, 2006, the U.S. has on average destroyed 300,000 single-family homes a year. So that's 6 years. Over basically 1.5 million dwellings have been destroyed, not to include Katrina in that. The supply of new homes coming on the market is barely exceeding the destruction rate. And again, it's a working off of an excess. Now, what's happened is since the peak of the housing market, 2006, there are 10 million more people in the U.S., and they haven't found single-family homes. Where are they? No one's really sure. They're doubling up with Aunt Grace, or they're with mom and dad, or they're in apartments. What's happened to apartment rents? Apartment rents have been driven so high now, they're higher than the cost of owning a single-family home. So one of the discussions that's going on around the United States on Sunday afternoons is you hear the stereo upstairs, you hear the dog barking, you're in an apartment, and you say to your spouse, honey, could we really own that house down the street cheaper than sending this money every month to our landlord? And that is what is happening. Rents have now gone above the cost of owning a home. What about home affordability? Highest since they've been keeping this index. 35 years of home affordability numbers are out there. That's the all-in cost of mortgage, insurance, and principal payments for owning a house. Most affordable now in history. You begin to look at all this and you say, shouldn't inventory for homes for sale be dropping? And it is. We're down to 4.2 months of homes for sale in the U.S. This is back to a 50-year average. So the excesses appear to be working off. What's happened then? If inventory is falling, population's grown, and affordability is there, interest rate credit is available, prices should be going up. Are prices going up in the housing market? Yes. The Case-Shiller Index shows about 5 or 6% annualized gains right now in the U.S. housing market. 19 of 20 markets moving up, including Detroit. Bidding war is happening just blocks from where you are for condominiums. And it's beginning to ripple through the economy. And what happens then is contractors say, maybe I can make money with that piece of land I have. Maybe we'll build a house. And that's what's going on. So I would suggest... Now, let's talk about tail risks and the strength of these against the risks that are out there. The headline risks are, number 1, Cyprus, Italy, Portugal, Europe falling apart. Number 2, sequestration in the United States. Will tax increases and fiscal cuts bring the economy into recession. And 3, is China a bubble? Will the emerging market countries bring us into recession? Number 1, let's measure the strength of what we've talked about, housing, pent-up demand, against what Europe could do to us. Europe has big problems, and again, I think it's unit labor cost, not debt. But if you look at Europe's problems, number 1, from a trade point of view, 2% of U.S. GDP is traded with Europe. They've been in recession now over a year. I don't think that's going to bring us into recession. Number 2, if their banking system collapsed or they broke up the euro currency, or allowed it to break up, would that lead to a fiscal crisis in the United States, a recession? Yes, I think that would be the case. Will that happen? Here's my analysis, short and simple. I say follow the money, and here it goes. The biggest economy in Europe, barely in recession, just above recession, is Germany. All right, what are they doing? What is different about Germany that you might bring up to this group? Their economy looks like almost no other economy on this planet. 50% of their economy is export. China, for example, is 36, US is 12. So what does that matter? Well, their taxpayer, let's say you're 62 years old, you're a taxpayer in Germany, you got an election coming up next September, you really resent working at a car factory, an Audi factory in Leipzig in a snowstorm, and you're 62 years old, and you're going to send your tax dollars to someone in Greece, 50 years old, retired, sitting on the Mediterranean sipping wine? No way, you're real angry. So this isn't going to work for me. I'm throwing Mrs. Merkel out. Let's get out of the euro. But wait a minute. These countries, the Club Med is what we're calling them, Italy, Portugal, Spain, those guys who, you know, got into trouble, they are in trouble, they're meandering through this recession. They do have too much debt, but they also have a competitive problem, labor. But anyway, does Germany need to bail them out? And the answer is simply yes, because Germany's tied to a currency that's been dragged down by those same guys. It's like Brer Rabbit. Don't throw me in that briar patch. No. We know what would happen to the German economy if they let any of this go. We can track it with the Swiss franc. The Swiss franc is not part of the euro. It's 50% higher than the euro. It continues to go up against the euro. Try selling Audis or BMWs in Beijing, Hollywood, New York at a 50% increase. It would collapse the economy. They would be 20% unemployment. Forget it. So in my opinion, you follow the money. Germany's incentive is very real, very strong to hold this thing together. Number 2, sequestration in the United States, all this fiscal cliff, whatever's going on in the U.S. March 1st, we had tax increases go through in the U.S. Everything we look at says the multiplier is not really very high on tax increases. People's behavior changes a little, but it doesn't seem to have a big effect on the economy. Probably slows it down some, particularly because consumption in the U.S., about 40% of it comes from the top 10%, and that's who the President and the Congress want to target with these higher increases. But sequestration, which is fiscal cuts, has a high multiplier effect, and that is a risk to our economy. We've done the numbers on where these cuts will occur. There's been all these compromises, and no one's sure how much is coming. But in any event, assume some fiscal cuts. We've seen it in the job numbers. Jobs have been cut by the U.S. government. Bottom line is we think 0.6 to 1% drag on the economy this year and next from these fiscal cuts, defense cuts, healthcare cuts. But the offset to it is, and we do these numbers too, in our view, it's housing, manufacturing exports, and cap goods adds about 2.5% to GDP, and the U.S. continues to go to 2% GDP rate. China, India, is at a bubble, still bursting. We don't think it's a bubble at all. We think that this was engineered by all the central banks outside the U.S. and Europe. The People's Bank of China had raised rates a year ago to find a lower inflation rate. They got it. They got to slow down their economy. And for 8 months, they've been stimulating. These economies are very geared to monetary policy, and you're going to see better growth. Not fabulous growth, but better growth this year out of China. We're already seeing it in some of their PMIs. We're seeing it in loan growth. We're seeing it in money supply. A little bit better numbers are starting to come through in India. Brazil, not yet, but we think they will. But bottom line is we don't think it's a bubble, and we do think that emerging market stocks happen to be very cheap given what's going on. So let me just talk very briefly about investment ideas. Let me just show you this. In this kind of world, I'm just comparing bonds to stocks here. This is a naive chart, but this is a historic wide. The blue line is how much you're paying in the world of the 10-year Treasury, the benchmark bond, for $1 of earnings. So when you buy a 10-year Treasury, you're getting a promise of money from the U.S. government. Whether you think it's a good deal or not isn't relevant. But when you think of how few dollars you put into the stock market to get $1 of earnings, you can see the gap has never been wider. So if you buy my argument that this is not a recessionary period we're going into, that the cycle's not over, you would have to ask yourself, are stocks rich? Well, they're certainly not rich compared to bonds, and there are asset allocation programs all over the world. Pension funds and hedge funds have them that would continue to say we have to rebalance toward stocks away from bonds because there's very little inherent value in the bond market. And if you want to go back and look at bubbles, you could certainly say that this is beginning to look like a bond bubble. Now, I don't think it's a bond bubble because I don't know that there's any euphoria or any crazy expectations about the world of bonds right now. The U.S. central bank, the Fed, is buying these things. The People's Bank of China still loves them. So I don't think we're near any kind of bond cliff. I do think there's general erosion of value coming in the bond market. But what about stocks? The U.S. stock market has been up a lot. It's been the great performer around the world. Is it too rich? Has it gone too far? My answer is no, and I look at cash flow and earnings. Again, record cash flow, earnings still growing, operating leverage, which means the fixed cost base of these companies in the U.S. is very low. A little bit of revenue growth coming either from China or a little bit of recovery in Europe, not expecting a lot, will drop to the bottom line. And right now we're paying about 14.1 times next year's earnings to own stocks in the S&P. That historically is pretty close to average. At peaks, if this were a peak or a cycle peak in the stock market, we'd be paying 18 to 19 times earnings, and we're not. We're paying 14 times. So conclusion number one, if you're trying to decide how to invest, I would definitely think you would tilt. Bonds are always a great asset allocator, but insurance against disaster. But right now, stocks have an inherent appeal. Within the stock market, dividend-paying stocks, I still think, are a very good way to think about the stock market. Not in terms of the highest dividend yielders, but in terms of the cash flow growers that can have the cover to sustain that dividend pace. And this just shows you, on average, what your return is if you buy a bunch of companies that never paid dividends. And the top line is companies that grow their dividends, and in between are sort of the S&P itself. The evidence is pretty compelling that dividends matter. 40% of your return over long periods of time comes from the dividend stream, but it's important to understand who can make those dividend payments and who can't. And so I think dividend strategies do matter if they're intelligently based. The next thing I think is a remarkable story. It's the sector of the S&P called tech. This sector, we're just looking here at earnings per dollar share, cash flow per dollar of sales. We compare it to economic value. Here's a sector of the stock market that trades at a 12 times PE. The market trades at 13, 14 times. So it's cheaper than the market. It has a lower beta than the market. It's moving less than the market right now. It trades at a much lower PE than electric utilities in Ohio that sell the same electricity they were selling 60 years ago. These companies, 3 product revolutions going on now, massive change in society, has a reach into the Chinese middle class who loves and is growing our technology, our apps, our software. These companies have no debt on their balance sheets, no financial risk. They're awash in cash. They've changed the way society works, and yet a basket of these things. I'm not talking Apple or Facebook. I don't understand any of those. My kids were on MySpace, then they're on Facebook. I've been on TV 100 times, and I've got 8 friends on Facebook. My daughter has 897 friends, and she's never been on television. So don't ask me about Facebook or Apple. But the companies underneath Facebook and Apple, the ones that have been running the storage and the pipeline and the cloud and these internetworking systems. These companies have not become glamour children, and they're generating massive amounts of profits, and no one seems to care. So my bottom line is, if you're looking for a place to invest in the U.S. stock market that seems cheap, that's growing like crazy and has no financial risk, changing society, here it is, staring you right in the face. And these companies never used to pay dividends. They're starting to. So it fits my number one thesis, which is dividends. My last idea here is I talked about the emerging market countries coming back. If you're a long-term investor and you think about growth of the urbanization that's still ahead of us in China, and you think about Brazil, you think about Russia, think about India, the stocks of these countries have not recovered. The U.S. is up dramatically year-to-date, 10%. These stock markets are up, some negative, some only 1 or 2%. They are trailing their forward valuation metrics by about 15 to 20%. I think another idea is to forget this whole idea, is there a bubble outside the U.S.? The long-term future of the world is in these countries. And right now, the world's too scared to invest, and I think it's a pretty good value proposition. So that's basically it. Let me summarize how and why I think the way I do. There are a lot of people out there, they put me on TV arguing that the cycle can sustain itself, and the argument out there is that the sky's falling, there's too much debt. Rogoff and Reinhardt across the river have done more studies of this whole debt phenomenon by governments than anyone else on the planet. And if you read their stuff, they said there is a threshold where too much government debt can throttle back growth. And that is at when you get 90 to 100% debt to GDP, your economy doesn't end in recession, it doesn't explode, it doesn't collapse. It just goes to a third lower trend rate growth than you were experiencing before you hit this debt mountain of 90 to 100%. Guess what? The U.S. was growing at 3.5% since World War II on average. We've just hit the 90 to 100% debt to GDP, and how have we been growing during the cycle? 2%. Exactly a third less, almost exactly what Rogoff. You should Google them if you haven't studied them, really interesting study. 2, I don't see a recession coming because of the inherent growth factors in our economy, pent-up demand, consumption, housing. Outside the U.S., the risks are actually getting better, and the 3 tail risks that I've outlined, which is European collapse, bubble bursting in China, or our own fiscal problems in the U.S., don't see any of those pushing the train off the tracks. So if you could raise your hands and ask me any questions, I'll be glad to take any question you have.
First, thank you, James, for coming to Northeastern. My question deals with what are your biggest concerns with the Fed zero's interest rate policy, like bond yield, high yield bonds fell below 6% last year, and junk bond issuances are at an all-time high this past quarter.
Yeah, there are 2 concerns I have. One is, are they creating another bubble? And I think anytime you give away free money, particularly negative real interest rate money, you are going to create a bubble somewhere, somehow. Someone's going to take advantage of it. I'm amazed CFOs aren't borrowing like crazy right now, taking out long-term corporate bonds and just borrowing. My view is that that hasn't happened yet, but it probably will. And I think speculation will come back, and I think there will be a bubble. Number 2 is, we don't see it yet. We don't see any signs of inflationary pressures. And that's because there's slack in the economy. Too much labor, particularly unskilled labor, and too much idle factory or capacity in the system. But those gaps are narrowing. And when we historically have gone below 7% unemployment rate, that is historically when the existing wage force can say to their bosses, all right, now I want a raise. We haven't seen it in this cycle yet, but I think at the rate non-farm payroll is growing, it's not growing dramatically, will be below 7% unemployment by year end. Number 2, the goods part of our society, which is still important, manufacturing of things, is at 78, 79% capacity utilization, and typically inflation in goods occurs at 80% usage rate. And at the growth rate we're going now, if this is sustained, we'll be there by December of this year. And that means the two things that need to close to create inflation will be there. And then what's the Fed going to do? How are they going to get rid of all these bonds? How are they going to fight inflation? I don't know. No one's ever been. This is unorthodox policy. This is crazy what we're in for. And I don't know how they unwind. I don't think they even thought about it. Maybe they're not going to sell this stuff, but there's a massive amount of bonds that could come on the market. So out there somewhere is a risk to the bond market, not in the near term, from what they're doing.
Thank you.
All right, so I know you mentioned the 90 to 100% debt level to GDP. Are you saying that we have to stay under that level, or we can continue to grow at the 2% level? And then also, now that you're talking about as a percentage of GDP, why do you think right now we're talking about the debt ceiling as a fixed dollar value as opposed to a percentage?
Yeah, so the whole question is how much debt for a country is too much. And now, no one really knew. No one had studied this in a methodical, scientific way until Rogoff-Reinhardt. And they went back over 800 years of data, and there seems to be a recurring pattern. Now, does it mean we should stop there? It probably does, but they don't suggest in their data that your economy goes into depression because of the debt. You know, the stock of debt, the amount of debt to GDP seems to be an inhibiting force on growth. In other words, it taxes the younger generation. In other words, they spend a longer part of their lifetime working to pay off the debt as opposed to getting an increase in the standard of living. That is behind a lot of these arguments in Congress about where are we going, how much debt is too much debt. Historically, you can't pursue a path of keep raising taxes just to catch up with the debt. Typically, that doesn't work because recessions and wars are what really creates these problems. If we go into another recession, the government's going to have to bail out the unemployed, and we're going to be in a worse fix. Do I think this causes depression? No. And one thing seriously missing in Rogoff-Reinhardt is they never studied a country that was the reserve currency of the world. And that is one out we have. And we have a central bank that's artificially lowering the cost of borrowing for the Treasury Department and probably succeeds in kicking the can down the road. I'm sure there's a day of reckoning coming, but right now, the government's not crowding out the capital markets. The taxation thing is slowing growth down a little bit, but not a lot. I think we can go on for years at this level here. Thanks. Great question.
Hi. You mentioned that housing would be a sector that would lead the U.S. economy out, or continue driving the U.S. economy towards a recovery. And we've seen housing prices turn around, building permits pick up, and housing starts as well. But why have we not seen mortgages continue to be lended by financial institutions?
Well, I might differ with you. Now, the numbers I'm looking at, I'll tell you what I look at and what is a signal to me about the housing market is the big money center banks typically make their money for what we call C&I loans, commercial industrial loans. The regional and state type banks, the smaller regional banks, make most of their money by mortgage lending, commercial and individual real estate. And those banks, and again, we're bottoms up fundamental, those regional banks are showing an increase in tonnage of mortgages, applications approved, not only applications coming in the door, but applications approved. The credit rating of the average American family is higher now than it was before the last crisis, and bank willingness to lend seems to be improving. I can't give you any statistics off the top of my head, but it seems to be we're going down that road, but we don't want to go down that road where we're giving credit to anyone at any price. Right now, it seems to be very rational. It seems to be these people have to prove they have jobs. They've got to have 10, 20% down. And that seems to be driving the growth we are seeing in the housing market. So I think it's a sustainable, solid, at this point, rational improvement in lending. But I agree, if credit availability dries up, this housing story will dry up. But right now, the numbers I'm seeing suggest it continues. By the way, I'm just going to interject one quick thing I forgot to say. If you're interested, my firm, MFS, is a long-only type shop, so that would differentiate what we do day to day from, let's say, a hedge fund or a trading operation or an investment bank. We reward our analysts and our portfolio managers on rolling 3-year, whether they pick good companies. That's what really we do, or good credits over the long run. So it makes us different than some parts of Wall Street. It's a very highly valued part of Wall Street, though, the ability to analyze a company's balance sheet and P&L. But if you want to get a glimpse into my company, in today's Barron's, this week in Barron's, we're the main article, and they feature our CEO, and he explains what my company does and give you an idea as to what MFS is about and companies like it are about. So I highly recommend you read it. It's a pretty interesting article. Yes?
Yes. Sorry, I wanted to talk about the IT sector. I agree with you that it's where we need to invest. But I think a lot of people are getting blinded that companies like Facebook, Zynga, I heard yesterday Google wanted to buy WhatsApp for $1 billion. And I was wondering if you think this could create another internet bubble or tech bubble.
Yeah, so could another internet bubble occur? One of the ways you can measure bubbles, and one of the concerns we would have about the market in general, is a big rise in M&A activity. Several things we look for at a market peak. One of them is M&A activity exceeding 7% of the names in the S&P. We're nowhere near that now. But there is a lot of M&A activity in the tech sector. They have a lot of cash. There's a lot of growth for sale. And it's with the multiples that are in most of these tech companies, it's a cheap way to gain growth. Typically, we don't like to see takeovers at our firm. We like to see organic growth, which is internal product-driven growth. But it is starting to happen in tech. I don't think we're anywhere near a bubble. The reason I would say that is, and the way I would gauge that is, how much of these companies' budgets are going to M&A. It's still a small percent. 2 is the forward valuation. If we're roughly right on what earnings are going to be next year from the tech sector, these transactions are occurring at 20-30% above current multiples. That's not the sign of a bubble. It's when you get to 30, 40, 50%, which does happen. We're not seeing a sign of that. And the overall PE of the sector still remains way cheaper than the market itself, abnormally cheap. So I put that all together and say, you're right, you got to watch it. There could be big mistakes being made. I don't know Zynga versus Google or any of that, but in general, the key indicators are not there, and so far, credit's not being involved in these M&As, which is a good sign. When we get to that point, I would say watch out. But so far, it's probably rational, and a lot of these are synergistic, what we would call strategic takeovers. So they don't seem silly yet, in general. Thanks.
Thank you very much.
Hi. My name is Ayo. I have another question building off the last two. IT being another main driver for progress. Just contradicting from what you said, saying too much capital going to one economy or industry tends to make way for a recession. My question more or less is, what's your take on with the gradual raise of standards of living and poverty slowly being eroded? Technology is going to boom like no other because you have, people having access to more accessible means to technology. And with these emerging markets, most of them, their currencies are pegged to the dollar. And you'll have US corporations come in now to leverage, I guess, the industries and markets and hopefully have it being benchmarked against US companies. So in terms of longevity, would this be a problem? As I said, too much capital going to one economy or industry makes room for another recession.
Yeah, so I'm not sure if your thesis is that we're seeing too much capital going to one industry.
I believe it's coming about.
In technology?
Yeah.
Yeah.
With all these M&As and...
Well, let me give you the best comparison I've lived with. Let's go back to the tech bubble. One of the ways you can measure if too much capital is going into a sector is to look at its proportion of that sector to the economy and then to the market, how much the market is valuing it at. So in 2000, the tech sector was supplying 18% of the earnings of the overall U.S. publicly traded companies. So 18%, and it comprised 35% of the entire value of the market. So twice the earnings, you're paying twice the earnings proportion just to own that sector. Its proportion to the economy was like 4 or 5%. Today, tech is supplying 18% of all the earnings, exactly the same as it was in 2000. But it's only 18% of the market capitalization, of the entire value of the market. So right in line with the earnings. And now it comprises about 7 or 8% of GDP. So it's a bigger part of our economy. We're paying less for it and getting a lot more for it. So the day will probably come when too much money chases that sector. But it's also a global sector now. It originates here. The intellectual property originates here, but most of the sales are coming from outside the U.S. I don't see that stopping or saturating anytime soon. So that's how I would do it. I don't want to take away from our next panelist, so how about one more question? I want to make sure we have time for all your other guests. So one more.
Hi. I like your thoughts on cloud technology, because I know you mentioned that. Just because I know from doing some research, roughly 60 to 70% of all businesses are kind of moving that way. It kind of goes to your point of how companies have been underfunding CapEx, and they might be, moving towards that. So.
Did you say biotechnology or
No, cloud technology.
Oh, cloud technology. I'm sorry, I couldn't hear you.
Sorry.
Yeah, absolutely. So one of the big growth areas that we see is how the cloud is going to be maintained, particularly the public cloud, for private corporations. And I think it's a huge growth area, but I'll tell you the big impediment, and I think we're getting close to getting a breakthrough there. A company like mine is a fiduciary, so we handle other people's money. We don't use the public cloud. Could we save, could we get 5 or 10 points more in margin on our company? Yeah, if we went to the cloud. We could really have huge savings if we went to the cloud, but we won't because of the security and privacy concerns. This is the big impediment. Huge. Banks have this problem. Anyone dealing with really sensitive information is very scared of that. We're getting to the point now where the market is willing to accept the security in the cloud. And I think that will be a huge breakthrough for the public cloud because it's going to, again, improve U.S. productivity first before it spreads around the world. So I think the cloud is a huge growth source. You know who the players are. We've mentioned a couple of them here. They're in other retail things, but it's the cloud that's going to drive their growth in the future, and we're a big believer in it. So anyway, I want to make sure our next speakers have plenty of time. I want to thank you all for your attention, and if you want to capture me any more questions that we didn't get to, we can do it up in the lobby so we don't disturb anyone else. Really appreciate your interest, great questions, and study hard and consider the investment industry. It's a gas, it's a lot of fun, and I love it. Thank you.